I would now like to invite our keynote speaker, Mr. Asif Haroon, on stage to discuss the impact of federal budget on direct taxation. Mr. Haroon is a fellow member of Institute of Chartered Accountants of Pakistan and is a tax partner at AF Ferguson & Co., a member firm of PwC Network. Mr. Haroon has been in the profession for the last 15 years and has been dealing with one of the largest multinational and national entities. Ladies and gentlemen, a big round of applause for Mr. Asif Haroon.
Bismillahirrahmanirrahim. Assalamu alaikum, ladies and gentlemen. In this session, I will be discussing some major amendments in the direct taxation laws through the Finance Bill 2022. In the overall context, if you see the amendments, we can see that there are some positive amendments towards taxation of the non-productive assets and those who are earning high income as compared to increasing the indirect taxation incidence on the masses. However, there are certain amendments which needs reconsideration, particularly those relating to revival of presumptive tax regimes on the commercial importers as well as on the retailers. I have divided the major amendments into 6 categories: revenue measures, real estate banking industry, documentation of economy and anti-tax avoidance, individual taxation, and procedural amendments. If I start from the key amendments relating to the revenue measures, then the first and the most important proposal is that they have the government has proposed to levy a special tax which is called a poverty alleviation tax, which has been imposed on every person earning income above 300 million at the rate of 2%. And this tax has been imposed with effect from tax year 2020. So if you see the mode and manner of collection which has been described in the law, this is almost similar to the super tax which was introduced in tax year 2015. And we all know that the super tax levy is right now pending before the Supreme Court, whether that tax can be collected through the money bill or whether a tax can be collected in the name of particular function. For example, in this case also, the government has attempted to name this special levy as a poverty alleviation tax. So government should, in my personal view, government should reconsider naming any particular tax, for the reason that by virtue of just naming that levy into a special name, the litigation and the controversy starts. So if the government wants to impose any tax, then the government can simply enhance the tax rate or just say it is an income tax rather than naming it as any special tax or poverty alleviation tax. The second major revenue measure is relating to the CVT, which has been imposed. CVT, we all know that it was introduced in 1989 through a special provision, and now this has been revived. CVT was abolished in 2020, but now it has been revised. And the one major and the most innovative suggestion is that the CVT will be collected on all offshore assets owned by a resident individual. The law is silent about from which tax year this is applicable, but if we consider the general provisions applicable proposed in the finance bill, all such amendments are generally applicable from the next, which means that it will be payable from tax year 2023, which would mean that in the coming financial year, the government would not be able to collect the CVT for the reason that the tax returns for the 2023 will be filed in after June 2023. CVT is payable every year, so this tax will be collected by the government every year. There is an issue that whether this tax can be collected on immobile properties, for the reason that the tax on the immobile property is the right of the provinces, but there is a view that the federation's right exists beyond the territorial jurisdiction. So if there is an immobile property situated in Pakistan, then yes, the province has the right to impose tax. But if the property is situated outside Pakistan, then there is a view and there is a argument that this tax can be collected from the offshore assets. The third major amendment is that the contribution to the approved gratuity fund and the approved pension fund have been disallowed if the contribution for the year is more than 50%. So whatever is the P&L charge in the books, the the charge above 50% will be disallowed straight away. There is a rationale which is that the end recipient is exempt. So there is a view that if there is an international best practice that there should be one stage taxation either at the contribution stage or at the investment stage, then when the funds are invested by the gratuity fund, or if the tax should be imposed at the receiving end. So the government has chosen to impose tax at the contribution stage when the expenditure will be recorded and the contribution will be made by the employer into these funds. The fourth major amendment is the carry forward of the minimum tax on turnover. We all know that minimum tax is payable at the rate of 1.5% every year, irrespective of whether you earn the income or not. And since 2004, the concept of carry forward of minimum tax exists, but suddenly the government has withdrawn the facility of carry forward of the minimum tax, which will have a huge impact on the balance sheets of the company, because most of the companies have carried the deferred tax of this carry forward of the minimum tax, which will be affected. And the government should seriously consider clarifying its position that if they even want to withdraw this carry forward facility, they should clarify that this will apply from the minimum tax arising from the next year. The other amendment relates to the capital assets, which are generally the shares of the private limited company. Since inception of the laws, 1979 law or even the 2001 ordinance, and there is a reduction which is allowed of 25% if the capital asset is disposed of after 1 year of holding. This reduction has been withdrawn. The income from government securities, which was taxed at the rate of 15%, final tax, this 15% tax was capped and introduced last year. This now tax has been withdrawn. This reduced taxation and the final taxation has been withdrawn, and now income from the government security will be taxed at par with the income from bank deposits at the normal rates. CGT on listed securities, again, there is an increase in the taxation rate of 2.5% if the securities will be disposed of within a year. So right now it's 12.5%, and now the tax will be 15%. And the export of the IT services, which is now at present is 100% tax credit, this tax now on all export proceeds on IT and IT-enabled services, tax at the rate of 0.25% will be imposed. In the real estate sector, there are very, very major changes. The first major change is relating to the deemed rental. The law now says that the government will deem the deemed rental income, which is effectively translated into 1% of the FBR value, and that tax will be payable by every resident person, not individual, every resident person. The exceptions which so far has been mentioned in the bill are self-owned property or any property which is being used for business or for the agriculture purposes. These are the exceptions. There are a lot of issues in the constitutional validity as well as the legality of this taxation under the income tax law. And there are also certain clarifications which are required, whether if the property is not given on rent, whether the government can deem the income on such property or not. The CGT regime on the disposal of the immovable properties, yes, that regime has also been revamped. Now the holding period of 4 years has been extended to 6 years for the open plots, and as well as the tax rates have also been enhanced. So the government is expected to collect more revenues because there is a calculation that if the holding period is enhanced 1 year, the government collects 20 billion more revenue. So considering that, it is expected that the government will be able to collect more tax revenues under this amendment. Advance tax on purchase of property the general rate on purchase and sale has been increased from 1 to 2%, and besides that, the purchase of immovable property by the person who is not on ATL, that person will be required to pay tax at 5%. In my personal view, this 5% tax should be increased much more, because technically this person is buying the property from the income which has not been taxed in the past. In the banking industry, again, there is a huge increase in the tax incidence. The general rate, which is inclusive of the super tax or the poverty elevation tax, so effectively the general rate has been increased from 39% right now to 41% for the tax year 2022 and 47% for tax year 2023. So there will be retrospective tax charge which will be made in the books of banks. Likewise, the tax incidence on their income from government securities, if their ADR ratio is below 50%, again, there is a significant tax increase in the tax incidence on the income from the government securities. And the third major amendment is that banks are now required to collect withholding tax from the payments of to the MasterCards or Visa card companies or the payment gateways, and the tax on, collection on credit cards or debit card, which was withdrawn last year. This has now again been reintroduced. So banks will collect 1% tax on all the credit, on the payments, on the credit or remittance through credit or debit cards. The amendment which relates to or affects to the documentation of economy, there are 4 major amendments. The first and the most critical amendment, which is in my personal view is extremely anti-documentation, is that the revival of the presumptive tax regime or final tax regime for the commercial importers. The government should reconsider this proposal for the reason that they were brought into the minimum tax regime after a lot of efforts and lot of pressures which were taken by the government when that presumptive tax regime was converted into the minimum tax regime. So that proposal needs to be reconsidered. The final tax regime has been introduced for the small retailers, which are technically called non-tier 1 retailers. If they will pay the tax on the sales tax, if they will pay sales tax on the electricity bills, the maximum amount which they are required to pay is 50,000. Small retailers are considered if their electricity bill for the year is 12 lakh or less for the year. So they will actually pay maximum amount of income tax or sales tax. If they will pay sales tax of 50,000, that will also discharge their income tax liability. So the government is expected to introduce special provisions with regard to their filing of the tax returns. In my personal view, if the government wants to retain the presumptive tax or final tax regime for the commercial importers or as well as for the retailers, the government should at least introduce the concept of the imputed income, so that they cannot take into account whatever amount they want to into their wealth statement. So there should be check and balance on the amount they can take into the wealth statements. Some positive corrections has been made for the valuation of the asset acquired to tax neutral transactions like gifts and inheritance. Record of beneficial owner of the company and AO to be now to be furnished to the FBR. With respect to the individual taxation, they have reduced their tax incidences, but simultaneously they have also withdrawn the tax credits, certain tax credits available. One major amendment is relating to the tax residency, that that any Pakistani citizen who will not be a tax resident of any country outside Pakistan, that person will be considered as a resident individual. There are a lot of issues coming out of this proposal, but in my view, if, for example, if a person is resident of any Gulf country, in my personal view, that those persons will be protected under the tax treaty. But yes, the government needs to provide some more clarity on this proposal. There are certain important amendments relating to the procedural sides. The time period for finalization of the assessment has been increased from 180 to 180 days. In the ADRC, there are positive changes, but one major negative change is that the taxpayer, the litigant, is now required to withdraw the appeal before participation in the ADR processing. That amendment needs to be reconsidered. The mandatory requirement of audit report after conclusion of the audit proceeding, that has been abolished. But one positive change is that now there will be one audit in 4 years. Last is that if the requirement of maintaining the records relating to the offshore assets or the income, that requirement now technically, if you see that that person is now required to maintain the record effectively for the lifetime, for the reason that offshore assets and offshore incomes can be taxed in the year of the recovery. So in the year of the recovery, if the tax officer will ask, then that person will be required to provide the record. This is very, very a serious amendment which should be reconsidered, because that is practically not possible to for anyone to maintain such record. For example, if a person is residing outside Pakistan for 20 years and coming back to Pakistan after 20 years at the time of retirement, then the commissioner can go and ask that to provide the receipts and the records of the assets that person has created over the last 20 years. So this is virtually impossible. In the last, I would just like to summarize few suggestions which should be considered by the government in expansion of the tax net. We all know that there is a huge amount of indirect tax. In my calculation, it is around 64% total tax. Within the total tax, the indirect tax comprises of 64%, and if you include the withholding tax and considering withholding tax as the indirect tax, then effectively more than 90% of the tax is collected through indirect taxes. And if you see that the effort-based collection of the FBR, which it is hardly 1 and 2%. So the 2022 5,000 FBR officers, they are able to collect only 1 to 2% of the tax through their efforts. 98% of the tax is being collected either through withholding tax or through the voluntary payments. Sales tax collection at the import stage is around 56% of the total sales tax collection, and if we calculate the total FBR collection, then almost 50% of the taxes are collected at the import stage. So if the last year imports were $56 billion, and if in this year there will be $75 billion imports, then effectively the government will be able to collect, just on the further reason that the exchange rate has been increased and $20 billion of the imports increased, the government has collected more than 700 billion rupees for the total taxes. So this is an automatic collection, and for the next year, if the government is targeting to reduce or contract the imports, then there will be reduction in the tax collection. So that will disturb the government. The government has budgeted the amounts of the tax collection from the imports. There is a dire need to reduce the reliance of the government on the tax collected through indirect taxes. So I think the time is coming up. In the last, I would just like to mention that the government always speak about that they are short of tax revenue, but the government is not focusing on their expenditure side also. If you look into in 2010, the government the share of provinces was 29%, which has now increased to 43%. But from the expenditure side, the federal government expenses has increased, which were of total receipts, it was 115% in 2010. Now these are 129%. So the government needs to also look into the expenditure side also and try to reduce their expenses. If they have already devolved their functions and the responsibility to the provinces, then the government should also transfer the expenditure side towards the provinces along with the revenues. So, thank you for patience listening to my.